Tonight, we're going to be discussing Japanese candlesticks. And Japanese candlesticks are not just a chart or a charting method, they're also a trading method. Now, in tonight's class, I'm going to use the term security, but I might use stocks, bonds, I might say commodities or futures. I might say Bitcoin or cryptocurrency, or I might say CFDs. In principle, I'm talking about any asset that is traded in the financial markets, in the open financial markets. And it just gets very boring saying security, security, security. So don't mix it up. I'm not going to say something that just is for the stock market and something that's just for the Forex market. Okay, I'm just using the word to make it interesting. Also, I intermix the terms investing and trading. Now, typically an investor takes a longer term position, and most of us are here tonight because we signed up for the webinar and we're looking to be traders. And traders take a much shorter term position. But in either case, the concepts we're talking about tonight are equally adept for any type of asset and any type of market and any type of investing or trading. Now, the fact is, anything and everything we do with a chart falls in the field of technical analysis. And all of us are trying to get an answer to, should I buy today? Should I sell today? What will the prices be an hour from now or next week or next year? Wouldn't investing be easy if we knew the answers to these questions? But alas, I don't have a Ouija board. I don't have a crystal ball. And if you're attending this class tonight in the hopes that technical analysis and using candlesticks has the answer to these questions, I'm afraid I have to disappoint you early. It doesn't. However, if you're attending this webinar with the hopes that technical analysis and the use of candlesticks will improve your investing and trading, I've got good news for you. It will sure do that. Now, candlesticks are one of the oldest charting methods in the marketplace. They were around before the financial markets ever existed. Definitely around before online trading existed. And definitely around longer than the New York Stock Exchange or Dow theory or anything else. It's been around since the 17th century. And it was developed by rice traders. But it eventually made it to the Western world. The fact is, I've been trading for 45 years now. And when I started trading, we had to do everything by hand. And we would sit in a broker's office because there was no computers then. And we got everything by ticker tape. Or calls up from the floor. That was it. So the only way to get to know prices instantly was watching those ticker tapes come in, or a broker who had traders on the floor would be calling back and forth with prices, but their prices were constantly changing by the second. But the markets didn't work that fast. But since we were hand charting and there was no online trading, we're sitting in the pit in a broker's office waiting for the data. And you're sitting there with binders with huge amounts of graph paper with all of your charts in there. Now, most of us in those days, I traded commodities. But the most you could trade was 1 or 2 or 3 commodities. I traded orange juice and coffee. Other friends traded pork bellies and livestock. But you had to be limited because you couldn't get the data fast enough. You couldn't get all the USDA crops. You couldn't find out what was happening in Brazil with the orange crop. You couldn't find out about the weather in Florida, the hurricane in Florida, because everything was a lot slower, as you know, 45 years ago. But the fact is, the reason I'm telling this is because we also had to do charting by hand. So in those days, candlesticks were not popular because they were a time-consuming process. And when you're doing all of your charts by hand and you have something that's more time-consuming, didn't help you so much. But with the growth of online trading and the advancement of the computers, and today with automatic computer charts and Java charts and data flowing out, and all you have to do is push a button and you can set up candlesticks, and when the candlesticks are just popping up on your chart, candlesticks have become one of the most widely used charting methods. Unfortunately, it's also been a downfall for a lot of traders because they see lots of red and green on their charts and they think that's trying to tell them something. and they don't spend the time learning about candlesticks. They just see reds and greens. Candlesticks have very little to do with the amount of red and green you see on your chart. Now, just as a byline tonight, if you look on your screen, I've given you 3 handouts. One is called the Candlestick Cheat Sheet. Okay. That is very important because that gives you the most well-known, most dependable candlestick patterns. And you need to know all of those patterns if you want to use candlesticks. Because candlesticks have very little to do with the reds and greens that you see on a chart. They have to do with the patterns made by the candlesticks and the preceding and the post candle and what they're trying to tell you. And there are candlesticks like the doji and like the Hammurabi and the Marabuzu. You have to understand what these individual candles do. But then you have 3 green soldiers, 3 black crows. You have evening candles, morning star candles. All of these are patterns in the candlesticks that are important for you to know. You have bullish engulfing patterns and bearish engulfing patterns. And again, it has very little to do with the reds and the greens. But the first thing we have to know is how to read an individual candlestick. Now, each candlestick is made up of the same 4 pieces of information that a bar chart is made up, because they all have the same information: open, high, low, and close. That's it. So what you do with a candlestick is you put a bar across at the open price. Now, if you're looking at a 1-hour chart, that would be the beginning of the hour, and the end of the hour would be 1 hour later. If you're looking at a 15-minute chart, it'd be the beginning of 15 minutes and 15 minutes later. You then put a line across at the close of that 1 hour period. You put a dot at the highest price that asset reached in that 1 hour period, and a dot at the lowest point that chart reached in 1 hour period. You then connect the bars together, and then connect the dot to the bar, and you draw your candlestick. Now, this is called the body of the candle. These are called the wicks or the shadows. Now, if you stepped down from the open to the close, that would be a bearish session, and you would fill in that candle with red. If you stepped up from the open to the close, that would be a bullish session, and you would fill in the candle with the green. Now, as you notice, we have 2 very different candlesticks here. We have a very long bodied candlestick and we have a shorter bodied candlestick. We also have a candlestick where the entire body of the next candle is enclosed within the body of the previous candle. This is telling you something. We don't care whether they're reds and greens. We care about the bodies, the wicks, and the shape of the the relationship between the current candle and the current candle and the preceding candle. Now, a side comment is a lot of times when you're reading about or learning about candlesticks, and especially a lot of the popular patterns, are still called blacks and whites. Because in my old days, again, when we go back 45 years ago, and you were doing your charts by hand, you only had a pencil in your hand. So what happened is, if it was a bullish session, you would just not fill in a color in the chart. And so therefore, it would be a white candle because it just wasn't colored in. If it was a bearish session, you would just take the side of your pencil and fill in that candle. And this would be a bearish session. And what happened was, this candle would then be black because you filled it in with the side of your pencil. And this candle would be hollow or white. And so we have lots of things that we talk about black and white candles. Black and white candles are the same as green and red. Just today we have everything in color. But a lot of these candlesticks have been around since the 17th century. A lot of the names of the patterns And a lot of the literature you read will talk about black and white candles. But the fact is, it doesn't matter if the candles are orange and purple, chartreuse and gold. You can set them up any which way you want, as long as you know which is bullish and which is bearish. That's all that's important. So a candlestick contains the same information that a bar chart contains: open, high, low, and close. Except the candlestick gives us an easy to decipher picture of price action. Immediately, a trader can compare the relationship between the open and the close, as well as the high and low. The relationship between the open and close is considered vital information and form the essence of the candlestick. Now, let me share with you a little presentation I've got for you that'll explain this to you a little bit better and show it to you in a graphic format. And then we'll go on talking about the different patterns and what they mean.
The balance between buyers and sellers, you could look at the size and color of the candlestick. When the body of the candlestick is bearish but small, as you see here, there is a relative equilibrium between the bulls and the bears. We can see that because the candle is bearish, there is slightly more selling pressure than buying pressure. As more bears enter the market, the selling pressure increases and the body of the bearish candles become longer under this added selling pressure. This is because the extra selling pressure is moving the price further down. Therefore, the longer the body of a bearish candlestick, the more selling pressure there is. This is the same when bullish candles form. As the sentiment changes and more bulls enter the market, a bullish candle will begin to form. The small blue candlestick shows that there is, more or less, a balance between bulls and bears, but with slightly more pressure from the bullish side. As more bulls enter the market, the body of the bullish candlestick will grow larger as it pushes the price further up. Therefore, the longer the body of the bullish candlestick, the more buying pressure existed in the market when that candlestick formed. The balance between the bulls and the bears can change during the formation of a candlestick. As we can see, sentiment is changing as this candle forms. The body of the candle starts to get smaller and smaller, thereby forming the lower wick of the candlestick. In this example, we see that the period started out bearish, but as sentiment changed and the bears left the market, the body of the candlestick started to retreat back towards the upside. When the balance shifted towards the bulls, the candlestick turned bullish, shown by the blue candlestick. The longer the wicks are after the candle has formed, the more dramatic the change in sentiment was whilst the candle was being formed. When there is an equal balance between the buyers and the sellers, this is known as a doji. The doji is characterized by the very small body relative to the wicks. A very small body shows the equal balance between the bulls and the bears. Whenever the bulls managed to push the price up, the bears entered the market to push the price back down again. Then, when the bears succeeded in pushing the price down, the bulls entered and pushed the price back up. Because the balance shifted neither in favor of the bulls nor the bears, the candle formed as a small body with long wicks. This is a doji. Whenever a doji appears, it means there is indecision in the market. A lot can happen during the period in which a candle forms, and the balance in power can shift from one side to the other. Therefore, at the beginning of the candle formation, it could be that the bulls are more in control than the bears. However, during the formation of the candle, sellers could come into the market and change the market sentiment, changing the candle significantly during the time it is formed. What may start out as a bullish candle could end up as a bearish candle. This means you should only ever base a decision on a closed candle. Normally, at the beginning of a new period, one candle opens where the previous candle closed. This does not happen all the time, however. On occasion, when the markets are closed and big news comes out, It can cause an imbalance between buyers and sellers. This imbalance is noted on a price chart by a gap in price when the market opens once again. So far, you have learned that the size of the body of the candle indicates whether the buyers or sellers are in control. That the larger a bullish body is in relation to its wicks, the more the buyers are in control. And the larger a bearish body is in relation to its wicks, the more the sellers are in control.
So what does the shape and the size of the candle tell you? It tells you the battle between the bears and the bulls. Okay. And as you saw in our little presentation, it's starting to tell you what market sentiment is, who's controlling the market, and what the overall sentiment is. Now, there are only basically 6 different variations. You can have, like in variation 1, you have an average size candle or a larger candle and small wicks on either side, and it closed higher than it opened. That tells you that the bulls were basically in control for most of that trading session. You have the opposite where it trades in a bearish session, and that tells you the bears were in control. Now the wicks try to tell you a little bit about, if you imagine it's a tug of war, and there's 2 teams on either side of the riverbank pulling the other team in and out. Well, when you see long wicks, that tells you the other team, for some reason, got some energy and yanked everybody into the river. But before they could pull the last person in, they got their footing back and yanked everybody back and ended up where they started. And then you have small body candles and no body candles like you saw with the doji. So before turning to single and multiple candlestick patterns, there are a few general guidelines we have to cover. But now that you have the basic idea of what candlesticks indicate with their bodies and wicks, let's cut our teeth in some simple, uncomplicated candlestick patterns. So let me pop you up on a chart, and let's just go over this on a live chart. Okay. So each one of these candles gives us a piece of information. Now, as you see, we have the most current candle. I just want to get my marker on here. This one candle that's appearing on our chart is the current candle for the current price. So this is not a closed candlestick. And this is what we were talking about in the video. Okay. This candlestick could look green for a second, but could close red, because until it closes, until that time period is over, you're not sure. So what that candlestick is showing you is that right now the bulls are in control, but that end of that period, that ended, in this case, the 30-minute chart we're looking at, it could end up as a red candle or a bullish or bearish candle. So you never want to trade from an incomplete candle. And as soon as this session is over, this period, the next candle will appear. So you ought to always realize that this candle is always an open candle. But just because in this candlestick we see lots of reds doesn't tell us we necessarily have a downtrend, or doesn't tell you want to trade down. What we're looking at is, again, is the relationship to the different candles, and also in a relationship to the trend, as well as the shape and size of the bodies. Now, I mentioned earlier a Marabuza. See this candle here? This happens to be an extremely long one, which is very, very rare. So something happened in the markets, and just let me get my markers off of here. So something happened in the market, okay, and said the euro skyrocketing, or actually I think it's probably the dollar fell. But what we do is we saw this big candle. Okay, forget the size of this candle. There's something very unique about this candle. You see what it is? There is no bottom wick and there's no top wick. This is why it's called a Marabuza. A Marabuza has no wicks. That tells you that the bulls opened this session and they were running full steam without stopping. And the only reason it didn't go any farther is because the session closed. That 30-minute period that we're looking at right now on a 30-minute chart was over. So it just started the next candle here. So a Marubozu tells you the market, whether it's red or green, is if it's green, that the bulls started out in control because there was no bottom wick. So that means the bears never even got one edge pulling it down lower, and it was running straight up. But that doesn't also either tell you you're moving into an uptrend, because what happens is the bulls kept pushing up, even the next time frame. But then look what happened. We got a red candle. Well, red candles to be expected because the buyers who bought down here and took advantage of that, they're sitting here and they're selling off, taking a huge profit. But these candles are telling us something. But you have to understand what the candles are telling you by their shape and position and their pattern. So we've already talked about building the candlestick chart and what the candlestick means on a chart. We've learned how to read the open, the high, the low, and the close. We've talked about candlestick shapes and sizes, the formation. We talked about position. We talked about doji, talked about the tops and the shadows. We talked about the bulls and the bears. We haven't talked about hammers and hanging men yet, and we haven't talked about haramis yet. Now, these are all what we call single candlestick patterns. The doji was one candlestick that told you something about market indecision. The harami, the Marubozu that we just looked at, was a single candlestick pattern. So it tells you something about that time period, but doesn't help you make a trading decision. Now, harami and hanging men and hammers are a little bit more complicated candles that tell you something by their relationship to where they are. I'm sorry, I know I'm hurting your eyes. So we have, and the chart in front of you, I didn't make up. Okay, but it's a standard chart, except somebody over here named these cutely Lonesome Cowboys 2 for Tango 3 Musketeers. We just call them single, double, and triple candlestick patterns. So we have several different single candlestick patterns, and they're on that cheat sheet I gave you. Okay. The Marubozu, we have a spinning top, we have a doji, we have a hammer, a hanging man, and basically a hammer and a hanging man are exactly what they look like. A hammer is a long lower wick and a small body up top. So they're a variation of a small body candle. The hanging man is just the opposite. There's a long upper whip with a little body, so it looks like the man's being dangled from or being hung from a string. These tell you that a trend might be ending when they appear in the opposite trend. But then we go, but these are not, and then we also saw shooting stars. Shooting stars when the market gapped up and the next candle was a little bit higher, so it looked like it shot up. Then we go on to the more complicated ones. There are two candlestick patterns. Now, bullish engulfing and bearish engulfing are two of the most well-known candlestick patterns. We look for these and we read about them a lot. We talk about them a lot. And they tell you that a trend is probably ending. And then from there, we go on to three candlestick patterns. Three candlestick patterns sometimes are very complicated to see. And you have morning stars and evening stars. You have three white soldiers and three black crows, three inside out and three upside down. Okay. Three inside up and three inside down are very easy to see. They're three consecutive candles in the same color, but there's a little bit more rules to them. 3 white soldiers and 3 black crows are 3 candles in either direction. Now they were called white and black. Why? You remember my old candle story about candlesticks? The old days? So there are 16 patterns you must know, because these are the primary, the top patterns that candlesticks make, and each of these candlesticks do tell you something. Each of these patterns, when they develop, tell you something. Now again, they're on that cheat sheet I gave you, but you have bullish harami, you have bearish harami. Basically, for each bullish pattern, you have a bearish pattern. They can be called something, so like you have the hammer and the hanging man. They're just simply opposite of each other. You have the inverted hammer and the shooting star. You have bullish engulfing and bearish engulfing. You have morning star and evening. So they're uptrends and downtrends. But you need to know what these are and you have to learn to recognize them and know what to do when you see them. So because bullish and bearish engulfing are so popular, I'm going to share a little presentation with you on them. And then we'll talk about how to use them in your trading.
Using candlesticks in conjunction with each other can indicate market sentiment by highlighting a shift in power between the buyers and the sellers. Candlestick patterns can therefore provide signals such as a reversal of price action. An engulfing pattern is a strong reversal signal made up of 2 candlesticks. There are 2 types of engulfing patterns, a bearish engulfing pattern and a bullish engulfing pattern. There are 3 main characteristics for spotting these patterns. The market must not be ranging. There has to be an uptrend or downtrend preceding the pattern, even if it is short-term. Secondly, the body of the first candle must be smaller than the body of the second candle. It is not necessary for the second body to engulf the actual wick of the first candlestick, although this does create an even stronger signal when it does. And finally, the second candlestick body must be opposite in color to the first candlestick body. For example, if the first candlestick is bullish, the second candlestick must be bearish. Let's have a closer look at the characteristics of a bullish engulfing pattern. You can see in this example, the market is in a downtrend. Notice the highlighted area where the first candlestick of the pattern is bearish, shown by its orange color. The second candlestick in the pattern is bullish, indicated by its blue color, and engulfs the body of the preceding bearish candlestick. These characteristics signal the reversal of the downward trend to the upside and demonstrate how the bears were overpowered by the bulls. Let's now have a look at the characteristics of a bearish engulfing pattern. You can see in this example the market is in an uptrend. Notice the highlighted area where the first candlestick of the pattern is bullish, shown by its blue color. The second candlestick in the pattern is bearish, indicated by its orange color, and engulfs the body of the preceding bullish candlestick. These characteristics signal the reversal of the uptrend to the downside and demonstrate how the bulls were overpowered by the bears. Tweezer patterns are formed by 2 candlesticks that have matching highs or lows. As the 2 wicks have the same height, it has the appearance of a pair of tweezers. A discrepancy of a few pips is acceptable. There are 2 types of tweezer patterns, a tweezer top and a tweezer bottom. As with the engulfing candle patterns, there has to be an up or down trend preceding the pattern. The market must not be ranging. Tweezer tops are formed by 2 candlesticks that have matching highs and can help spot a trend reversal. You can see in this example that the market is in an uptrend. The upper wick of the first candle shows signs of the buyers losing momentum. The upper wick of the second candlestick in the pattern represents a second attempt by the buyers to continue pushing price up and then being overcome by the sellers. The wicks are of equal length and the highs are at the same level. These characteristics can signal the reversal of the uptrend to the downside and demonstrate how the bulls were overpowered by the bears. Tweezer bottoms are formed by 2 candlesticks that have matching lows and can help spot a trend reversal. You can see in this example that the market is in a downtrend. The lower wick of the first candle shows signs of the sellers losing momentum. The lower wick of the second candlestick in the pattern represents a second attempt by the sellers to continue pushing price down and then being overcome by the buyers. The wicks are of equal length and the lows are at the same level. These characteristics can signal the reversal of the downtrend to the upside and demonstrate how the bears were overpowered by the bulls. Keep in mind that the bodies or wicks do not have to be exactly the same size or even in consecutive order. Here we see a tweezers pattern with a candlestick in between. The important aspect when looking for a tweezers pattern is two wicks with equal highs or lows, indicating that either the buyers or the sellers were eventually overcome after a trend, indicating a potential reversal. So far you have learned that dual candlestick patterns can indicate a change in trend, but not necessarily an immediate or significant reversal. In an engulfing pattern, the body of the first candlestick must be smaller than the second one, and the color of the second candlestick body must be opposite in color to the first candlestick body. And finally, for a tweezer top or bottom, the wick of the second candlestick has matching highs or lows with the first candlestick's wick.
So those are the two most popular two candlestick patterns. You have the tweezers and the engulfing. You have bearish and bullish engulfing, bearish and bullish tweezers. From here, we go on to the three candlestick patterns. Now, evening star and morning star are the opposite of each other. They consist of three candles. So they're a little bit more complicated to see. I find the evening star and the morning star so complicated to see, and very rarely do they help you. I've not found them to be I don't find them that I can notice them and then see them and then trade them. They are difficult to see. They consist of three candles. The first candle is a long green candle during an ongoing uptrend. This candle represents strong bullish sentiment. Then it's followed by a short candle, a very short body candle with either a green or red long wick. And this candle represents a sudden break in the bullish trend with indecisiveness. And this candle is then followed by the third candle, a red candle, which is more than half the length of the first green candle. This candle represents a comparatively strong change in the sentiment of the market. So you can see that up here in a little sketch, and then you can see it in the pattern. So an evening star only appears at the end of an uptrend. The morning star, which is the exact opposite, appears at the end of a downtrend. Then we go to three white soldiers and three black crows. Now, again, these are trend reversal patterns. Okay. Three white soldiers is a bullish reversal pattern. It's made up of a trio of long green candles during a downtrend, each appearing after the other, opening within the range of the previous period and closing near the current period's high. Three black crows is the opposite. It appears at the end of an uptrend and is a reversal from that uptrend. And then we go to the three inside up and three inside down. They are as complicated as the morning star and the evening star, but they are again reversal patterns. They are on your cheat sheet so you can see them. Now, I'm sure you're all sitting back and saying, wow. When you go through all the various patterns, you're either ready to go into the trading battlefield with this newly acquired knowledge, or you want to sit back and shout, stop it, I'm too confused with all of these funny names, shapes, and can't remember any of these. Well, if you remember that each candle is simply an observation of market sentiment. You don't have to remember all of these names. You should remember when you see the pattern develop, what it's trying to tell you. And it takes a while. It's not something that comes very quickly. Okay. But with time, your eyes will start to notice these, and you'll be able to start incorporating them into your everyday trading. But the best ways to use candlesticks is in combination with other indicators, such as pivot points and support and resistance. You can trade with candles only, okay, but it's not a good idea. Okay. So just remember that each candlestick is just telling you the battle of the bulls and the bears and the sentiment going on in the marketplace. So again, you have your cheat sheet. I also gave you the handout on reading financial charts, as well as the investing.com introduction to technical analysis. And all of this will explain all of it together to get you started. Then once you've mastered this, you can start using candlesticks to find your entry points, your exit points. You can use candlesticks to show you where you should be putting your stop losses. Okay. So candlesticks can help you in every part of your trading, but it takes time to learn and understand what they're trying to do. Okay. You're not going to master candlesticks in one class. You're not going to master candlesticks in one day. But once you've spent the time and studying that cheat sheet and learning the patterns and watching them and seeing them develop on your charts, you'll start being able to understand what they're doing. So whatever trading timescale you work on, candlesticks can be an incredibly powerful trading tool to help us judge what's coming at us right from our trading screens. There are many, many more patterns that you can learn to recognize. However, the patterns I've chosen to include are the ones that I find most useful. Either they appear regularly in charts, so you can put them to practical use every day, or they're powerful signals. So candlesticks can be used however you want them. Combine them with simple pieces of technical analysis, and they give you clear signals that the market is right for you to open your trade or close out a position. Use them alone, and you may find that you are too close to the price picture to see what's really going on. When used in conjunction with a successful trading strategy, I hope you find that candlestick analysis will enhance that system and improve its performance. And as you become more and more familiar with candles, you will learn to instinctively read the story that each one is trying to tell you. Now, a little helpful information, or a little bit way to ease you into it, comes from investing.com. If you go over to the investing.com website and click on any of the assets and open up the charts, you'll see across the top technical analysis. Click on it and look for Japanese or candlestick patterns. Click on it and it will put the candlestick patterns directly on your charts. Now, you don't want to trade from the charts on investing.com because they're free charts, but they can alert you when a pattern has developed. That way you're not searching for them. And the nice thing is they'll tell you exactly what pattern you'll see exactly on the charts when it's developed, and because you just click on the button and it'll open it up. Or you can also decide what patterns are relevant to you. You can go to that asset and set it up. Once you set up a sign-in with investing.com, which you all did to come to the webinar, you just go click on the candlestick pattern, tell it what time frame, you click on the asset, click on the time frame you're interested in, what patterns you're interested in, what indications, what reliability, and click on apply, and you can set up a notifications, and it'll just send you a notification when a signal is developing. Or you can go over across the top navigation bar, click on Candlestick Patterns, and click on Customize, and you can tell it, pick the assets you're interested in, fill in the box, tell it all the things you're interested in, and it will keep track of all the assets that you want to trade and give you what's happening with each one of those assets. You click on the box and open up, and it'll give you all the information, and you can put them right on your charts directly from investing.com. Okay. So it makes it easy to be able to find those patterns without spending a great deal of time searching and then transfer them over to your charts. So there are many, there's also scanners you can get out there that'll scan Japanese candlesticks, or scripts that you can add to your charts. You know, today, because of computerized charts, all this has become a lot easier, but there are many easy ways to incorporate this into your trading, but it's going to take you a little bit of time to master. So on that note, I'm going to say goodnight to you. But if you go over to www.ubcfx and try out their charts, and you'll find that they have beautiful candlestick charts, and you're able to do everything and anything you need right on their trading platform. So thank you very much for joining us tonight, and thank you for supporting UBCFX, as well as investing.com. Good night now.